Greetings, everybody. Thank you for stopping by my channel. I am Charles Davis. This is Approved by Charles. I talk about how money with regards to mortgages can affect you, can improve your life, improve your station and wealth over the long term of your existence. So today I'm going to talk about a very exciting one, which is comparing additional monies to close. One of the questions I get asked a lot is, should I maximize my amount for the down payment? Should I minimize my amount for the down payment? Should I buy points? And what does that mean? And how does that look? So I'm going to show you a demonstration today showing three different options. First of all, they're going to purchase a home that costs $630,000 and they have $500,000 cash to do it. In these three scenarios are put all your cash down, put 20% down, but don't buy any points. And put 20% down, but buy 2% in points. Just so you know, the interest rates that I will show you are accurate as far as today, November 28th, 2022, at about noon, Denver time. I am a broker, so all the points I'm going to show you, all the rates I'm going to show you are accurate for borrower paid compensation, meaning on your closing disclosure, there will be a line item that says broker compensation. That's what you're going to pay myself and my company and everybody else on the line to do this mortgage for you. So the reason for doing that is you get a much lower interest rate. So in the put your all cash down column, all these loans are 30-year fixed mortgages. They're all conventional mortgages. First column, they're going to put $504,000 or 80% of the purchase price down. Gives us a loan amount of $126,000, loan to value of 20%. And they have $0 left to invest, but their interest rate is 5.875%. Gives them a great principal and interest per month of $741.71, and that may be important to them. So if the lowest possible principal and interest is important to somebody, that's where the cash down can be played with to get you to that point. In the next column, 20% down, but not buying no points whatsoever, they're going to put down $126,000, which represents a down payment of 20%. Their loan amount is going to be $504,000, 80% loan to value. That means their balance left to invest is $374,000. Their rate is also 5.875%. Now, finally, in the last column, they want to put 20% down, but they want to buy 2% in points. Points are essentially prepaid interest to the investor. And so by doing so, you get a lower interest rate over the life of the loan and make a lower monthly mortgage payment, which is nice and can be valuable at times. So again, 20% down is $126,000. Represents down 20% down. Loan amount of $504,000. They're going to buy 2% points, or $9,662 in points, and that will save them $157 per month off their mortgage payment. The break even to that is 61.5 months. So a little over 5 years to break even, and that's important. If you're looking to buy points, you need to figure out or think about how long you're going to be in the property. If these particular people are only going to be in the property for 2 years, they're going to lose money by buying points because the break even is so far out. Anyway, the balance left to invest is $364,338, and the interest rate, because they did buy down those points, is going to be 5.375%. So you can see there is a big difference in the monthly payment between these options. Putting all that $500,000 cash down gets them a monthly all-in payment of around $1,300. 20% down, no points, that gets them a payment with, and again, we're including HOA, hazard insurance, and property taxes in these calculations. And that changes per property, but that gives you a $3,500-ish monthly payment, and 20% down with points gets you an interest rate in that same range as well. So that's super awesome. But here's what I really wanted to show you is comparing putting the money down versus investing it and the amount you'll save. So in column one, you don't have any money to put down, so you're not going to. So all these numbers are zero. I'm using the S&P 500 moving average, which is 9.64% over the last 40 years. That's the same for all of these right here. In the 20% down with no points, that $374,000 invested in the S&P 500 at 9.64% per annum. In 3 years is going to be worth almost $500,000. In 5 years, a little over $600,000. In 10 years, almost $1 million. 15 and 20 years ends up at $2.5 million. So that's a significant amount of money that you can add to your wealth by investing versus buying the house with as much cash as possible. Certainly buying the house with as much cash has a benefit, But for your long-term wealth, the only thing you have in this scenario is the home. Home has value, certainly, and I'm not including those calculations here, just using the examples of the missed opportunity by not investing. 20% down versus the 2% points. So obviously my amount to invest is a little bit lower, $364,338. Same S&P 500, 9.64% per annum. And again, these are the numbers that you have access to over the next 20 years of money, of aggregated investing in the S&P 500. This next column, saved on the monthly mortgage payment. Remember, by buying those points, we are saving $157 a month. So I'm comparing in this column here how much you're saving on your monthly mortgage payment by buying those points up front, and what that 157 aggregates up to over 3 years, which is $5,658, over 5 years, $9,429, et cetera, all the way up to just about $40,000 after 20 years. Certainly not chump change, absolutely not a big deal. It makes sense to do in some cases. However, the opportunity lost versus not investing. So in this column here, this is if you did not buy points versus if you did buy points. So remember, that number is about $10,000 less between the two of them because of the points that you paid up front. So there's a difference over 3 years of $13,000 between the two, 15, 25, 40, and then almost $66,000 over 20 years. And then if you subtract out what you saved, very much saved, by buying points down, that $157 a month that you're saving per month, if you subtract out the money that you save on that, your net loss over time is, at the end of 20 years, is almost $30,000, meaning your wealth would be $30,000 higher if you had not bought those points and invested those $10,000, $9,662 in this case, over 20 years. And so that is the opportunity lost that you're losing. So again, all scenarios are different, all clients are different, everybody has different needs. However, my goal as a mortgage loan originator and somebody who's helping somebody think about complex financial decisions is to make the best decision for today, for tomorrow, and for way down the road, possibly farther than you're thinking about for down the road. That's my job as I see it, and that's why I'm able to do this complex math and show you how, really in the grand scheme of things, it makes no sense to buy a house with all cash unless you just can't afford anything more than $1,500, $1,302.71 per month for an all-in mortgage payment. If that's all you can afford, then by all means do it. However, if you can afford a higher monthly payment because of your financial situation, then it makes much more sense to invest those monies into a long-term investment play. And again, I'm using the S&P 500. Their moving average is pretty consistent and usually pretty conservative and pretty accurate. So again, thanks for watching. I hope you find this informative. I find the break-even analysis for points paid, again, I can almost never see an example where buying points makes sense. But it may make sense to you. And so I'm here to work for you, and however makes the most sense for you, that's what I'm going to do. Anyway, thank you very much for joining in. If you have any questions whatsoever, please comment below. Please like and subscribe, share with your friends if you find this informative, and certainly appreciate y'all stopping by. Have a great day.